Welcome to Waqar's Fine Airs, where we make finance simple and practical for your everyday life. Home equity. How much of your home do you actually own? Today, let's dive into an essential financial topic for homeowners: calculating the equity in your home. Whether you're considering a home equity loan, preparing for the future, or just curious about your net worth, your home equity plays a significant role in your financial landscape. But what exactly is home equity? And why should it matter to you? Let's break it down. What is home equity? Your home equity is the portion of your home that you actually own, the value that belongs to you, not the bank. It's incredibly easy to calculate. Home's current market value. Mortgage balance equals your home equity. For example, your home is worth $300,000. You owe $200,000 on your mortgage. This means your home equity is $100. Seems simple, right? But here's why it matters. Why does home equity matter? Knowing your home equity is crucial if you're thinking about applying for a home equity loan or line of credit, assessing your overall net worth, canceling private mortgage insurance, PMI. Let's focus on PMI. If you're paying it, you likely want to get rid of it ASAP. What is PMI, and when can you drop it? Private mortgage insurance, PMI, is an extra charge added to your monthly payment by lenders if your down payment or equity is less than 20%. Here's the kicker. PMI doesn't protect you. It protects the lender. On a $250,000 mortgage, PMI can cost anywhere from $104 to $208 a month. That's a significant amount, money you could be using for savings, investments, or paying down other debts. So when can you stop paying PMI? How to cancel PMI and save hundreds per year. Once your home equity hits 20%, you can request PMI cancellation. But important note, lenders won't automatically cancel it for you. You have to ask. For example, you buy a home for $200,000. You put down 50 cents. Over time, your home's value increases to $215,000. Your loan balance is now $170,000, but your home's worth more, giving you $45,000 in equity. That's over 20% equity, so you're eligible to drop PMI. But here's the catch: how to get PMI removed. Most lenders will require a professional appraisal to verify your home's value before canceling PMI. An appraisal typically costs a few $100s, but here's the good news. You'll make that cost back in just a few months by eliminating PMI payments. Every dollar you were paying toward PMI is now back in your pocket. Once PMI is removed, you can allocate that money to other financial goals, like paying off debt, investing for retirement, making home improvements. And the best part? You're saving hundreds, possibly thousands of dollars each year. Fast forward to 2025, what's changed? The housing market keeps changing, and home values have been on the rise. The average home price in the U.S. is now above $400,000. PMI costs have slightly increased due to market conditions. So, if you're near that 20% equity mark, it's time to contact your lender about canceling PMI. Every month you keep paying it is money you could be saving. The bottom line: equity was financial power. Your home isn't just where you live, it's an important financial asset. By regularly calculating your equity, requesting PMI cancellation once you reach 20% equity, using your home's value wisely, you're making smarter financial choices and getting the most out of your money. Homeownership isn't only about having a place to live, it's about building wealth. And the more you know, the more you can save. To refinance or not, let's break it down. When interest rates go down, refinancing your mortgage could save you hundreds each month and potentially tens of thousands over the course of your loan. But is it the right choice for you? Let's break it down. Why do homeowners refinance? Homeowners typically refinance for one of three main reasons. 1. Lower monthly payments. A reduction in interest rate means less money going to the lender and more staying in your wallet. 2. Access home equity. Need cash for a home improvement, college tuition, or a big expense? Refinancing allows you to tap into the equity you've built in your home. 3. Change mortgage type. If you have an adjustable rate mortgage and rates are climbing, refinancing to a fixed rate mortgage locks in predictable payments. For instance, if rates rise, your ARM payment could soar, but switching to a fixed-rate mortgage would shield you from those increases. Sounds great, but what's the catch? Refinancing comes with costs. Refinancing isn't without its fees, which can pile up to thousands of dollars. Some of these include appraisal fees, title insurance, loan origination fees. Before you refinance, ask yourself, how long do I plan to stay in this home? If you're planning to move soon, the savings may not offset the upfront costs. But if you're sticking around for a while, even a small rate drop could save you tens of thousands in the long run. The break-even point, your key to success. To figure out if refinancing is worth it, compare your current mortgage to the new one. Calculate how much you'll save each month. Divide your closing costs by your monthly savings. For example, refinancing saves you $200 a month. Closing costs are $4,000. Break-even point, 20 months. If you plan to stay longer than that, refinancing makes sense. Looking ahead to 2025, what's changed? The average 30-year fixed mortgage rate is now hovering around 6%. Closing costs have increased slightly, thanks to inflation. In conclusion, always check the latest rates and fees before making your decision. Refinancing is a powerful tool, but it's not a one-size-fits-all solution. Crunch the numbers, weigh the costs, and make the best choice for you. This video was brought to you by Books and Tax Professionals, a team of expert accountants dedicated to helping you achieve your financial goals. Whether you need accounting, bookkeeping, or virtual CFO services, we've got you covered. Visit our website or contact us today for a consultation. If you found this video helpful, don't forget to like this video, share it with others, subscribe for more financial tips and advice. Remember, every small step you take toward financial literacy brings you closer to your dreams. Thanks for watching, and we'll see you in the next video.